welcome to the Numerix video blog, your expert source for derivatives trends and topics. I'm Emily Ahern. As the dog days of summer continue to heat up, there's one market that continues to cool. It's no secret that the global commodity prices have seen a sharp decline this summer, but what is this signaling in terms of the world economy and broader recessionary trends? Here to discuss this is our friend Udi Sella, Vice President of Product Solutions, and our resident trading strategist and FX expert. Udi, thank you so much for joining us and welcome.
Good morning, Emily. My pleasure.
So Udi, as commodity prices fall, I expect this can have a major impact on raw material exporting, especially in countries which have been heavily dependent on rising demand from China. In particular, I'm thinking oil, iron ore, coal, and other industrial metals. So maybe you could take me through how the economic slowdown in China has impacted the commodities markets, and maybe it'd be interesting to touch on Australia and Canada.
Okay, Emily, thank you. That's a pretty vast question, so I'll try to address it in a few ways. So we have all kinds of commodities or commodity types that are weakening at this point in time. So if we start with oil, obviously some of the weakening in oil is related to the slowdown in China. So we know that the last growth or GDP growth numbers were 7% and probably are set to weaken. We've seen also the collapse in the equity markets in China and the impacts on the world, and obviously this probably means weaker demand from China. So again, less demand for commodities, etc. Interestingly, there was the agreement that was signed with Iran, which basically means that more oil supply will come to the market, hence lower prices. And indeed, since this agreement was signed, oil weakened further down, if you like, WTI below $47 a barrel, Brent around 52 and so forth. And then of course shale oils, which keeps production in the US is still high. So this relates to oil prices. Then if you look, we spoke of the slowdown in China, so this typically has impact on construction, raw materials, and so forth. And then if we look at gold, for instance, then you can see since the net disposable income in emerging economies, which tend to consume gold more than the proportion. If you like, India is the number one demand for gold. The biggest demand for gold comes from India. Since the slowdown in India, since the local currencies weaken, etc., the demand for gold is weakened as well. And this also takes us to inflation fears.
Sure.
Since inflationary fears have weakened, or the expectations for inflation, it's hard to find a country with a stable economy where inflation expectations are above 2%. Therefore, the demand for gold has weakened as well, and with the strengthening of the U.S. dollar, again, commodity price weakened. So that's more or less most of I'd say the biggest drivers for the weakening in commodities.
Sure. And so Udi, let's stick with kind of those emerging economies and the BRIC nations. The commodities dive has also led to, as you mentioned, increased unemployment in a large chunk of other emerging economies. So what has been the specific impact on countries like Brazil and Russia? And do you see the recession kind of deepening in these countries?
In short, yes. So we definitely see now currencies, local currencies at levels never seen before. If it is, South Africa, which is of course a commodity-related economy, if it is Brazil, real trading at something like 3.35, etc., or Russia, where the ruble again is going to hit 60, we know that there is this is also related to commodities. So take a look at Brazil. For instance, Brazil is it has huge US dollar denominated debt. And since the local currency has devalued so much, they're trying to dump commodities like sugar in order to have sufficient foreign funds. And again, the fact that they're dumping those prices makes the receivables lower, and then it has an impact on unemployment in Brazil specifically. Also takes inflation higher. You can also mention like an economy like New Zealand, which is very sensitive to milk prices, and milk futures have weakened a lot. And again, the the local currency, the New Zealand dollar or the Kiwi, has weakened a lot as well.
So Udi, looking forward, it's worth noting the widening gap between financial markets and the underlying, real economies. This can't last forever, so perhaps you can tell us a little bit about, what the result may be and how this gap might continue to widen.
So if we look at the main driver for the exchanges to go higher over the last 2-3 years, it was really the cheap money. Or the other way to look at it is that investors didn't have many alternatives. The two alternatives were really real estate market and stock markets, and obviously the main driver was the U.S. Given the scale, and given the fact that the quantitative easing in the U.S. has stopped, and supposedly rates would go higher a few months from now, either September or December probably. This is taking some off kick. And then you have all the commodity-related companies in the U.S., like in Texas, etc. And again, we see stocks softening of the sector. We see that the bonds are getting lower, and even investment grade bonds are getting hit because these companies have now a big problem with oil prices, hovering around $50. So I actually think, the golden age or the golden cycle towards its end.
Well, it certainly has not been a quiet summer. It's not the quiet summer that we usually expect, Udi. With interest rates, expected to rise in certain countries. We still have a low rate environment in Europe. The commodities diving, China's economic downturn. So thank you so much for joining us. And as these events continue to unfold, we're definitely going to be checking in with you again. So much appreciate you joining us. So on the Numerix video blog, it's our goal to examine the topics that you want to talk about. Keep the conversation going on LinkedIn and on Twitter @NX Analytics. Thanks for joining, and thanks a lot, Udi, for speaking with us today.